Hook and promise. Hey everyone, welcome back to the Capital Breakdown. Today, we're tackling a hot topic that's buzzing through personal finance circles: dividend ETFs. Do these funds actually pay you to wait patiently with a steady stream of cash, or could they be quietly capping your long-term growth potential? The big question is, are dividend ETFs a smart way to build passive income, or are they a hidden trap that can slow down your wealth over time? Stick with me for the next 12 minutes, and by the end, you'll have a clear understanding of how dividend ETFs work, the trade-offs involved, and how to think about them in your bigger financial picture. Let's dive in. The problem or confusion. So why is dividend investing so confusing for so many people? Well, a lot of us grew up hearing that dividends are like free money paid just for holding stocks. It sounds great. You get steady cash in your pocket no matter what the market does. But here's the catch. This idea can oversimplify what's really going on. Imagine you're at a fruit stand choosing baskets of apples. One basket has fewer apples but comes with some juice included, while the other has more apples but no juice. Dividend ETFs often feel like the basket with the juice. Regular payouts, but sometimes fewer apples overall. This can lead people to chase dividends without realizing they might be trading off bigger growth later on. Understanding this trade-off is key to making smarter choices. Core concept explained. Let's break it down simply. A dividend ETF is basically a basket of stocks chosen because those companies pay dividends, regular cash payouts to shareholders. Think of it like a pipe delivering water. The dividends are the flow of water coming out, giving you a stream of income. But here's the twist. Companies that pay dividends often do so because they have steady profits, but might not be growing as fast as others, reinvesting all their earnings back into the business. So while dividend ETFs provide income, they might not grow your money as quickly as growth-focused funds. The term passive income sounds appealing, but it's really just income that comes without you having to sell your shares. Yet it's not completely risk-free or guaranteed. Core concept explained. Continued. To add a bit more color. Dividend ETFs usually hold stocks from established sectors like utilities, consumer staples, or big financial firms. Think of them as the mature trees in the forest. They keep producing fruit steadily, but don't shoot up super tall quickly. Contrast that with younger saplings in tech or biotech sectors, which might grow fast, but don't pay dividends because they're reinvesting everything. So, dividend ETFs focus on companies sharing profits now, while growth funds focus on companies plowing profits back in for future expansion. Both have roles in a portfolio, but they serve different goals and time horizons. How it actually works now. What's happening behind the scenes when you invest in a dividend ETF? First, there's the fund provider who creates and manages the ETF. They select stocks based on dividend yield, payout history, and other criteria. Then investors like you and me buy shares of the ETF through brokers. The ETF collects dividends from all the underlying companies and passes that cash along to shareholders, usually monthly or quarterly. But remember, this setup isn't free. There are management fees that nibble away a bit your returns over time. Additionally, dividends are taxed differently depending on your location and account type, which can affect your net income. So while it seems like free cash, there are costs and tax considerations to keep in mind. How it actually works, continued. One more piece is the market price of the ETF shares themselves. If the companies in the ETF aren't growing much, the price may be stable or rise slowly. This means your total investment growth depends on both dividend payouts and share price appreciation. Sometimes high dividend payouts can come from companies borrowing money or selling assets, which might not be sustainable. So, the fund managers and regulators keep an eye on the health of these companies and the ETF's rules. But it's important for investors to stay informed and understand the mechanics too. Simple. concrete examples. Let's look at two simple examples. First, imagine Sarah, who invests a fixed amount every month into a broad index ETF that includes a mix of dividend payers and growth stocks. Over time, Sarah sees her investment grow steadily, with dividends reinvested to buy more shares, compounding her returns. It's a slow and steady approach, somewhat like planting a diverse garden and letting it flourish over years. Now picture Jake, who puts all his money into a single speculative stock, hoping for a quick windfall. This stock doesn't pay dividends but might offer rapid price swings. Jake feels the thrill of watching prices jump, but also the stress when they plunge. Compared to Sarah's calm and steady ride, Jake's path is riskier and more volatile. Dividend ETFs can sometimes offer a middle ground, regular income with potentially less price volatility. But they're not magic shields against market ups and downs. Simple, concrete examples continued. In Sarah's case, her dividend payouts provide a small but consistent cash flow that she can choose to spend or reinvest. The emotional benefit is a sense of progress and income, which can feel rewarding and motivating. Jake's experience is more like roller coaster investing, exciting but nerve-wracking. This contrast highlights how dividend ETFs might fit investors who want income and a smoother ride, but also why it's important to balance them with growth assets for long-term goals. Risks, traps, and common mistakes. Now, let's talk about where things can go wrong. One trap is chasing the highest dividend yields without looking at why those yields are high. Sometimes, a company's stock price drops sharply, pushing yield percentages up, but that might signal trouble ahead, like a company cutting dividends or facing financial stress. Another risk is overconcentration, putting too much money in dividend stocks from one sector or region, which can backfire if those industries face challenges. Also, dividend ETFs often lag during strong bull markets because they focus on mature companies with slower growth. Patience is key here. Expecting quick riches from dividends alone can lead to disappointment. Risks, traps, and common mistakes continued. Volatility is still present, even if a dividend ETF seems calmer. And tax drag, the taxes paid on dividend income, can reduce overall returns compared to growth stocks held long-term. For investors with shorter time horizons or immediate income needs, dividend ETFs can make sense. But for those focused on wealth accumulation, balancing growth and income is crucial. Remember, no investment is completely safe. Understanding risks and staying diversified helps manage them. How to think about this tool. So where do dividend ETFs fit in your broader financial life? Think of your money like a multi-lane highway, with different lanes serving different purposes. Dividend ETFs can be a steady lane for generating income, especially useful if you're budgeting for expenses or building an emergency fund cushion. But for retirement or long-term wealth building, you'll likely want lanes that prioritize growth too. Align your investments with your goals, time horizon, and risk tolerance. Diversification across asset types helps smooth the ride. The capital breakdown encourages you to view dividend ETFs as one tool among many, not a silver bullet. How to think about this tool continued. Also, consider your emotional comfort. If seeing steady dividend checks helps you stay invested through market ups and downs, that's a real benefit. But don't let the allure of passive income blind you to the importance of total return and portfolio balance. It's always smart to maintain an emergency fund, keep debt in check, and plan your savings so you can ride out volatility without panic. The key is thoughtful, informed decisions, not chasing trends or quick fixes. Recap and educational disclaimer. Alright, let's wrap up. Today we uncovered that dividend ETFs offer a way to generate income through dividends, but that income often comes with trade-offs, like potentially slower growth and tax considerations. We saw how dividend ETFs work behind the scenes, the risks of chasing high yields, and how they might fit into a balanced financial plan. Remember, this video is purely educational, not personalized financial advice. Always do your own research and consider consulting a qualified professional before making any investment decisions. Thanks for spending these minutes with the Capital Breakdown. Keep learning, stay curious, and take confident steps toward your financial future. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.